Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer for SilverOak. With me today is Jonathan Charlo, also one of our partners and our lead analyst. And a little bit later in today's webinar, I'll be introducing a special guest joining us, our newest member of the SilverOak team, a Senior Director by the name of Chris Link. And Chris is going to go through some information with regards to the recently passed Secure Act. Before we get started though, just as a reminder, the webinar is scheduled for approximately 45 minutes. If you have any questions throughout that time, please feel free to contact your SilverOak advisor after the session. We welcome any questions or even ideas or suggestions for topics to discuss in future webinars. So I open that door up to anybody interested in walking through. And of course, I want to thank Jonathan and the rest of the team, John and everybody else that makes today's webinar happen, including the folks on the technical side. It seems like an easy endeavor, but it's a little bit more complicated than maybe what it looks like on the surface. And of course, since I am Chief Compliance Officer as well, I must note that we will be discussing the overall markets and economy during the webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We also will not be discussing specific portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our performance reports have been sent out within the last couple of weeks. And of course, we're reaching out to clients to discuss any issues as they need to be addressed. But if you have any specific questions and we haven't had a chance to reach out to you, I again welcome you to contact your SilverOak advisor. And lastly, past performance is no guarantee of future success. So let's look at the agenda. As usual, we'll start the discussion with economic data and kind of a conversation around what's happened over the last couple of months and where we think things will be headed. We'll transition into a discussion about the markets, both the equity markets and bond markets. We'll give you some perspective on our outlook moving forward, and then go through some SilverOak internal updates, things that have been happening here, including the addition of Chris as a Senior Director, but also talking about New Year planning tips as well, since it is the start of a new year, and Happy New Year to everybody that's in the audience. Chris will then join us to talk about the Secure Act, which there are components of that new tax law that will impact pretty much everybody in one way or another. And then again, I welcome any questions afterwards. Just pose those to your SilverOak advisor and any topics that you might have for future webinars, and we'll look into those. So Jonathan, you put here growth stabilized during the fourth quarter, and I've heard it say that it's slower but steady.
That's correct. And in fact, Q4 GDP, the first look came out yesterday, and it was right on with the same levels we saw in the third quarter, although some of the underlying components were different. So we've seen generally stronger consumer numbers, and the corporate sector has been weakening modestly over the last 3 to 4 months.
So if we look big picture at that, and starting first with the market dashboard, and of course the dashboard's broken into 4 major categories. The first one that we'll touch on is the economy. And here it looks like things really haven't changed from prior quarter, and we don't look to be making any changes in the projections over the next quarter or two. Is that?
That is correct.
Okay. As we go down into the credit markets, there is a little bit of a change, or at least projected change. So why don't you touch on that?
So credit market encompasses a number of different factors. One of the areas would be kind of overall spreads. And one of the things that we did see More recently is the credit spread has narrowed. We'll talk about that in the bonds, but that certainly is a factor that helps.
So that's a good thing, which is why we think if that trend continues in a quarter or two, we may change our rating. And again, I apologize for those who are new to the webinar, but this is laid out obviously in a columnar fashion by quarter. If you see the box grayed in as, or shaded in, excuse me, as gray, that's neutral. Green is positive, red is negative. So you're saying here with the credit markets, we may see a slight upgrade in those in a quarter or two. That's because of the spreads and a couple other factors.
Exactly, some underlying factors.
The third major category is valuations. And here we actually are seeing valuations in the red. It's the one category that you're going to see transitioning into kind of that negative territory. And I think you had mentioned, Jonathan, that if they looked back at last quarter's webinar, they'd actually see these projected colors gray, not red, but we've kind of taken a little bit more of a negative stance here.
That's correct. And honestly, we had a very nice fourth quarter. We'll see that later. That comes into play, and the model does look at forward earnings and trailing earnings. And when you put that together, the increase in the overall market level has raised the valuation, and therefore it had been neutral, and now it's slightly negative.
Sure. And again, for those new to the call, that basically means when valuations are red, that the stock market is just a little bit overvalued, a little bit too high based on fundamentals. And the last major category, the market sentiment. Here we're seeing some shading. Do you want to touch on what our thoughts are here? It's green, so it's positive.
It's green, and with market sentiment, the data that's part of this is really more market related. And so when the markets are doing well, that actually is good for this indicator. And so when we look back, you'll see last year in the fourth quarter, it was neutral, and we did see the market come down. But then again, with the recovery that we've seen in the markets, we did go green in the second quarter, and with where things are and kind of projected, it does still look positive.
Sure. And this also incorporates consumer confidence and some of the consumer sentiment numbers, which to your point, those have been positive as well. So in whole, our composite 6-month average has remained gray in that neutral category, neither positive nor negative. And in total, we still think that it will remain in that neutral category for the next quarter or two.
That's correct.
So drilling down into a little bit more on the dashboard, this is going into kind of a perspective of the history of the dashboard and where the current composite number is, as well as the 6-month trailing composite. And you can see in the top right, the current number is 3.38, and the current 6-month is 3.27. That's the 6-month average. Those are both now slightly above the threshold between positive and negative. So they're slightly in that positive category, although not necessarily, I would say, resoundingly in that positive category. But to that point, last quarter, they were mixed. I think it was the 6-month trailing, or the 6-month average anyway, had been slightly negative, right below the threshold. That's
correct. Last quarter it was actually at 3.21%, and so it's come up slightly just above that threshold level. And then just to give perspective on the current number, it was at 3.21. So that's a little bit of a healthier increase.
Sure. So my conclusion here, based on what we saw with the various components and then this composite, is frankly not a strong signal one way or the other, right? It's not a strong signal for markets doing really, really well. It's not a strong signal for markets doing really, really poorly at this point. Although we do see the S&P here is pretty highly valued.
Correct. Yes.
All right. So with that, let's transition to the economic factors. And as we look through these factors, we have the positive factors listed here. Has there been any changes in the positive factors from last quarter?
Not really. I mean, credit conditions, as we showed in the dashboard, have improved a little bit. We didn't put an arrow. I don't think they've really improved enough to be notable, but we've seen consumer confidence come out, and that's been relatively strong. People are still very positive about job outlook. Obviously, the employment numbers in the last couple of months have been positive. And from a corporate sector standpoint, we're having a good earnings seasons. We'll go through that before, so that has remained in the positive category.
Okay. Neutral. So were there any category changes in the neutral from last quarter?
No, and in fact, there really were no category changes at all. We did note a couple of positives, one being housing. So, essentially, we've seen interest rates decline. That has definitely helped. And in fact, when we look at housing starts in December, they reached a 13-year high. Now, in the last couple days, though, we did see pending home sales miss expectations. But when we look at the last 2 to 3 months, most of the data points have been very positive.
So we have an up arrow here. They're still neutral. Housing is still considered neutral, but moving toward maybe the positive category. That's the same as we look at commodity prices. Again, still neutral, but moving toward more positive kind of.
Correct. And in this case, because commodity prices have come down, it's a positive because they're inputs for manufacturers.
Good point. And then the negative category, as you mentioned, there were no changes in that category, but I do note that there's a couple of arrows, again, pointing toward maybe these shifting from negative to neutral at some point if the trend continues.
Yeah, and I would note that global growth did decline in terms of its growth rate last year. So what we're really signaling with this up arrow is that we've seen data in the last month kind of come up off of that bottom.
Right.
And so that's why it's still negative, but we are starting to see some signs.
Now, of course, the latest coronavirus could put a real damper on that global growth, considering the impact that it's already had and the unknown impact that it could have.
That's absolutely a definite wild card.
Tariffs, another negative, but maybe trending in the right direction.
Absolutely. So, the USMCA trade deal was signed a few days ago. We did see the US-Japan trade deal signed, and then of course we've seen the US-China trade deal signed. And so these are all potential positives as we go forward, but definitely they've had a negative impact on global manufacturing.
Sure. And the one thing that that we also put an up arrow on is Eurozone. So explain that one.
And that's another one where it's still in the negative category, because last year growth in the Eurozone was only up a little less than 0.5%. But in the last month, we've seen numbers come up a little bit. And again, as you mentioned, with the whole coronavirus, Europe is much more tied to China from a trade standpoint. And so again, that is going to be a wild card for the Eurozone.
Now, one item that we don't have on here, and it maybe falls under U.S. politics a little bit, but one that just kind of, I guess, came to light for me is the U.S. debt. I don't know if everybody saw, but the Congressional Budget Office, I think here within the last week, released projections of their forecasted deficits, which are into the trillions for the foreseeable future. And now, of course, we're at national debt levels well past $23 trillion. So it hasn't been talked about a lot. I think, I don't know, 4, 5, 6 years ago, there was some discussion about it. It's pretty much died. But I just have to believe at some point this is going to come up as another discussion item and may start impacting what people are thinking with regards to growth and corresponding market returns. So that's something you'll be keeping an eye on?
Absolutely. Of course, with interest rates being low, that's why people aren't concerned. But if we do see interest rates start to tick up, there'll be a lot of concern about the
Yes.
overall debt levels.
Fair point, fair point. So here we're going to show something that we haven't shown in the past, and that is a little bit more detail on the leading and coincident economic indicators. We've actually talked a little bit about at least the leading indicators for sure, but we've never shown the actual components of that nor of the coincidence. So let's walk through this, Jonathan.
Sure. So we have shown a graph with the leading economic indicators in past webinars, but we've never actually gone through the 10 components. And the reason I thought it would be a good exercise to look at this is that we've heard that the economy is strong, and that is definitely the case. But many of the things that people cite are actually coincident economic indicators. Those sort of data factors that really coincide with what's going on in the economy now and its overall trend. And so what we're going to see right down here, when you look at the level, it's strong and it's stable. And
so
then
the level of the coincident is strong at the bottom of this chart.
Correct, correct. And so then right below that, you can see there are 4 components. Payrolls are strong, personal income, industrial production are fair, and manufacturing sales are strong. But when you look at that trend, we're seeing that industrial production is worsening. We're seeing that personal income is improving, and then the other 2 factors are stable. Those are, definitely things that are going well. But one of the things we've seen recently, and in fact, when we look at household spending data that just came out, what we saw is that in the last 3 quarters, each subsequent quarter, that growth rate has been declining. And so that's a factor to consider. Now, looking at the leading economic index, though, they call it stable in terms of its level. And we've seen that in the overall number. However, in the last 2 to 3 months, that trend has been worsening. It has been coming down. And in fact, when you plot that on a diffusion index of 100 to 0, it is actually below the 50 line now. And so that's something that we have to consider. But when we look at the factors, there are 2 that are now weak and 4 that are fair, but a few of them have worsening trends, and a few of them also have stable trends that maybe are actually starting to weaken a bit.
So you're saying, like, as an example, average work week or unemployment claims or ICM new orders, those are all worsening trends.
Correct.
Those are getting worse, whereas new orders or new orders for consumer goods or for non-defense, building permits, leading credit index, average consumer expectations, those are stable, and only 2, the S&P 500, which is the markets, obviously improving because valuations are quite high, and interest rate spreads, which you already touched on as well.
Correct, correct.
So this is interesting because this is the leading economic index, meaning that it is forward looking. And if we put this into kind of that chart that we have seen in the past, you're seeing the trend on the far right come down, which is basically coinciding with what we just discussed in that table.
Right, and here we're just showing the 3-month average so that you can actually see that trend. And so you're going to see that blue line is right at that 0 line. That 0 line is the 50 line on a diffusion index. And so you're seeing that yellow line come down, and that's GDP.
Sure. And then what we're trying to do here is not get overly concerned with the slide in the LEI because it goes up and down. That doesn't necessarily mean that we're headed for a recession. But what you've done here is you've shown at what point, at least historically, has it come down to that starts to cause concern we are headed into that recession.
Right, and so that yellow dotted line is at that -5% level. We're not there yet.
And once we get there, that's kind of the catalyst that shortly thereafter we see a recession, or maybe we might even be in a recession at that point, but usually it's just before the recession.
Mhm.
Is that
So
right?
that's another way to look at it, because last year, you might remember, we a couple of times showed the inversion in the yield curve and
Sure.
how it wasn't necessarily a perfect indicator. So another way to think about it is we have kind of a second indicator that's been weakening a little bit, not yet showing absolute signs that a recession is coming, but kind of a yellow light.
Right. Well, and you mentioned the inversion of the yield curve. Remember when we talked about that, and people can listen to the prior webinars to hear the discussion about that inversion. It usually inverts and then goes back positive before the recession occurs. So even though we're out of the inversion, doesn't necessarily mean that that wasn't still an accurate signal. Time will tell. We'll see.
Absolutely, and it brings up an interesting point, because in the last week, because of the coronavirus fears, we've actually seen interest rates come back down, and we've had a slight inversion in the yield curve again. Not the 10-year yet, up to about 7 years.
Sure. So you had touched on manufacturing already, but here it's pretty apparent that that just continues to contract, which on one hand, with everything, the globalization of the world, you'd expect maybe manufacturing to contract, but at the same time, it's not something that's positive for the economy, and we would like to see some growth in that sector.
Absolutely. So again, it's kind of one of those things that tends to be a little bit more leading. And the viewpoint has been, this has really been the trade war issue. So there's been this thought that with the 3 deals, that maybe we would see trade pick up this year, which would help manufacturers.
Yeah. Well, with that, let's talk a little bit about the overall earnings environment, because this really is a key driver to supporting the valuations. We can have high valuations, but if earnings come in that can help justify and support those valuations, well, then they end up not being so high after all. So what are we seeing on the earnings?
So it's an interesting situation. We actually had very low earnings growth this year, and we'll show this in another chart, but valuation expanded. And so when we look at this quarter, it kind of followed the trend that we saw. Revenue growth in general is up about 2%, but profit growth is only up about 1% so far in this quarter. Now, from an earnings standpoint, we've had 224 S&P 500 companies report, and a majority of them have beaten estimates. So that's definitely a good thing. But the real issue is when you think of kind of 1% growth this year in earnings, we're actually projecting 9% growth in earnings in 2020. So that's a relatively high hurdle rate. And when you think
sorry to interrupt, but not
SilverOak, we being kind of the
right
economic consensus.
Exactly.
And so that's a big hurdle rate, especially with the trends that we've been seeing.
Right. Yeah.
So that is concerning.
Yes. Well, with that, let's transition our discussion to markets, because I think overall the summary of the economic is, again, kind of where we started. A little lower, a little slower, but still steady. How really did that impact the markets? And here you say strong quarter for risk assets and strong year for all assets. So let's look at some of these numbers. And if people haven't looked at their performance reports, I really encourage them to do so. This is a good year to look at your performance report. You'll be very happy. As we look through the equity markets, you'll see fourth quarter was strong across the board. So getting back to Jonathan's comment that the quarter was strong for risk assets and strong for all assets for the year. If we look at that, you'll see double-digit returns across the board. So that's nice, particularly, Jonathan, as we came off of 2018. And what we're showing here is that fourth quarter of 2018. If everybody remembers, actually in 18, the markets were positive going into October. But in early October, the Federal Reserve kind of suddenly changed course on interest rates. They started raising rates, and the stock market just got hammered. That was a tough quarter. Started bouncing back right after Christmas, and of course, January of 2019 was a strong month and strong first quarter. If we look at bonds, we'll see fourth quarter of 2019 was decent. Obviously, you know, relative to the equity returns, quite minor, but still positive. The year was much stronger, and this is maybe one of the frustrations I've had, and I don't know about you, Jonathan, but as I go through performance reports and discussions with clients, I get super excited about that 8.7% return in bonds. I mean, in my mind, that's phenomenal. But after they see 25% returns in equity markets, this is like nothing. They're so piddly. It's like, no, it was a great year in equities, sure, but it was also a great year in bonds.
Absolutely, and in fact, it was the best calendar year return since 2002.
Oh, I did not realize
so that kind of puts that in perspective.
Yeah. Well, and of course, if we look at the fourth quarter of 2018, remember I just talked about how bad that was for the equity markets. This is a nice reminder as to why people have bonds in their portfolio. And that's because even in those quarters or even years when the stock market's down, the bonds help mitigate that downside and provide some stability. So with that, let's look at the quarter and the year relative to the value versus growth allocation. And here we can also obviously see in the fourth quarter, growth continued to dominate, as did small cap. And that relates back to your earlier comment, risk assets did better. So small caps tend to be riskier than large cap, and growth tends to be riskier than value. For the year, of course, growth continues to dominate, but frankly, small cap wasn't that far behind for the whole year. And here I asked Jonathan to add this, and I appreciate you doing so, Jonathan, because this chart is trying to show us which years growth outperforms and which years value outperforms. So if the bar for the year is downward shaded, that means that growth outperformed that year. If it's upward shaded, that means value outperformed. And you can see that obviously the last couple of years, growth has dominated. But I wouldn't get too excited to expect that to be a trend continuing forever. And that's the point of this chart here, is that we'll see growth and value flip back and forth pretty regularly from year to year, from every 2 or 3 years on. So don't think that because it's worked the last year or two that it's going to continue to work forever. So Jonathan, this is showing the S&P return attribution. Walk us through this slide.
Okay, so the color to really focus on is that yellowish color. That is the PE multiple of the S&P 500. So if you look on the far left at 2018 returns, where the market was down about 4%, you'll see that that yellow shaded portion is negative. Valuation came down substantially last year, in 2018, I should say. But that kind of orangish color is earnings. So earnings were very strong, yet the market was down. And again, as you mentioned, that had to do with the Fed and what it did in the fourth quarter. But we wanted to show really what does this look like in 2019. And so the S&P was up more than 31%. You're going to see that orangish color, the earnings, that's a very small component of it. But you're going to see that yellow component is very large. That was valuation expansion. And that is really what drove the high returns last year. Now, the 2020 estimate is just to show you, again, that we mentioned that earnings are expected to increase pretty dramatically over 2019. And so, you know, together with dividends are expected to climb 10%. We don't know at this point whether that will happen. If it does happen and we don't see the PE change, that's the return potential that you could have. But again, the caveat is there are a lot of things going on, and it's unknowable at this point whether the market can hit that sort of growth.
Yeah, good point. So this chart, I think, gives us a nice kind of walk back in history. And it's looking at the asset class returns by decade, because we have just come off of two very distinct and conflicting decades. We have 2000 to 2009 here, where the S&P 500, which is circled there in red, was down about 1%. So that entire decade, you basically went nowhere in US large cap stocks, which is the S&P 500. Yet from 2010 to 2019, that following decade, up 13.5% on average for each of those years during the decade. I mean, that's pretty astonishing. And Jonathan, I know we talked about this back in 2009, coming off of the Great Recession, how so many very, very well-known and very respected folks in the industry were talking about the next decade was going to be lower returns than average.
And in fact, PIMCO, a very well-known bond manager, said that the new normal would be lower returns.
Yes. Yet, really, that's not at all what we experienced. And instead, we saw what is typical for a bear market, and that is the year following or the years following to have strong returns. Now, we obviously didn't see that kind of V-shaped recovery. We call that a V-shaped recovery. We didn't see that in the economy. It was a very U-shaped, very shallow recovery economically. But from a stock market perspective, this was just amazing to see. And of course, just the opposite is true in some of these other categories, where bonds were up 6% during the 2000 to 2009 decade, and yet in 2010 to 2019 they were only up 3.75%. So again, it's just such a sharp contrast.
Absolutely. And like the last entry, commodities,
that's a good
that
point
was
too.
a relatively high return in that decade, and yet in this decade, negative returns.
Yes, yeah. So again, just like we talked about with value and growth, a trend of a year or two or three doesn't make a longer term trend. This is going to that as well. Of course, this is similar data, same decades, but it's breaking down the S&P 500 into its sectors, and we saw a lot of the same kind of flipping of returns by sector, where IT, terrible decade, 2000 to 2009. Of course, the beginning of that decade, to be fair, was the tech bubble bursting, but then phenomenal returns for the 2010 to 2019.
And also another one to couple to highlight: consumer discretionary, negative returns; communication services, negative returns. Yet in this past decade, we saw high returns. And so that gets into the whole why has growth outperformed? Well, when you look at it, information technology and consumer discretionary are the two largest sectors within the growth style. And
Good
so when you look at one of the largest sectors within the value style, which is energy, it underperformed over the last decade. Now, we don't know if or when energy will necessarily outperform, but if it does, we should see better performance from the value side.
Sure. And I think this is super interesting, because it's a decade, it's 10 years. And I think people look at kind of 10-year time frames and say, well, if it hasn't worked in the last 10 years, why would it work in the next? And yet we see that there's that flipping of returns and performance even over decades.
It all comes back to this idea of reversion to the mean.
Yes. Yep. So with that, let's transition a discussion into bonds. And bond returns did moderate in the fourth quarter, so they weren't super impressive, but nonetheless still positive. However, for the year, very impressive.
Absolutely. And in fact, last quarter, when we were talking about year-to-date bond returns, we called them equity-like.
Yeah.
And that's really what we saw for the year.
I mean, we saw some of the corporate bonds that even are in our IQ's positions, our investment quality scoring system that we use for clients, up 10, 14% for the year. I mean, and those aren't high yield bonds. I mean, those are still high quality bonds. All right, with that, then let's talk about SilverOak's outlook. And starting with the economy, I would say, and we've been pretty consistent on this the last couple of quarters, that we are in the later kind of phase of this cycle. And although recession remains low, recent data is softening, which gets kind of to that slower but steady growth. We don't know when a recession is going to occur. And I know we've been relatively optimistic that one isn't going to happen in the near future, but at any point our optimism can change to some skepticism and then maybe to some pessimism. So it will happen at some point. We just don't know exactly when that transition is going to occur, but it is starting to maybe shift a little bit into that neutral category.
Yeah, absolutely. And when you think about it, when we look at the international economy, it hasn't done as well as the US economy. We talked about Europe being up 0.4% last year. If we don't see manufacturing improve, what if it actually slips more? And then the question would be, could the rest of the world pull the US into a recession?
Right. And back to the coronavirus, we were talking this morning how that's impacting the supply chain, which is obviously then going to have an impact on global GDP. I saw one of the big firms this morning lowered their GDP for China for this year by, I think, 0.4 or 0.5%. So that could be one of those kind of triggers to kind of slow down things enough over the next year or so to push us into a recession. Equities, we've already talked about the S&P 500 being kind of expanded in its valuations. So a pullback isn't necessarily going to be a surprise.
And I will tell you, I made this note before this week. So
good point.
I didn't, this isn't backdating that idea.
Yeah. Well, and we always say, hey, 10%, 15% corrections, they happen so often, they're impossible to identify. I mean, frankly, we have one on average a year, maybe even two in some years, and most people don't even know they occurred because by the end of the year, the market's recovered and everybody's, happy with their calendar year performance numbers. So one 10% pullback during the year or a 15% pullback would just not be a surprise at all. It's the bigger ones, the 25, the 30% pullbacks that tend to be associated with recessions that really we try and at least see them on the radar. So as we go through these bullet points, without getting into politics, anything that we want to highlight as we look forward on the equity markets, Jonathan?
The only other thing, I mean, we mentioned the 2020 election. I could have just as easily said the fourth year of a presidential cycle. When you look back, the fourth year tends to be a pretty dicey proposition. Very wide dispersion of options.
Yeah.
They could be nicely positive. They could be very negative.
So there's not a good trend there to stand on.
No, but I do think that with everything going on, we will see volatility pick up.
Sure. On the bond market, where do we see yields and spreads as we look forward?
Well, one of the things is I can say we don't think they're going to be equity-like returns in bonds this year.
Sure.
I think that returns are going to be more in line with the underlying yield. Now, the change to that outlook would be if growth did reassert itself, we could see the 10-year Treasury yield increase. We might see global bond yields increase. But other than that, I think we'll stay within kind of the range that we've been in. As you've mentioned before, we really have them in to provide protection. And then the other side too, and we talked about this a little bit, but credit spreads narrowed, meaning that more risky bonds did very, very well. And so you're not getting any more safety from owning those. And so, the cautionary is you want to stay high quality with your bonds. You don't want to buy the high yield or
Don't chase those
junk
returns
bonds.
from 2019.
Absolutely.
Yeah. So with that, let's transition our discussion from the economy and the markets into SilverOak updates and some new year planning tips for everybody as we are kind of closing out January, headed into February. So our updates, as I mentioned, want to welcome Chris Link as Senior Director. Chris comes with us with over 20 years of experience in both personal finance as well as tax planning and preparation. Excuse me, Chris is a CPA, also a CFP or certified financial planner. So Chris, welcome to the team.
Thank you. I'm excited to be here.
Been kind of quiet over there, but we're going to get to your section of the webinar here shortly. From an IQ's perspective, we had 2 positions that were added to our watch list, but that was just because of sub-advisor changes in management, not because of performance. But it's always good to note that we are monitoring not just performance, but a lot of other qualitative aspects to the positions we recommend. And we had several rating changes, which means what? That we take it from a good to an excellent, or from an excellent to a good, etc.
Absolutely.
Okay. White papers. We do have 2 white papers that hopefully will be released very soon. One on donor advised funds and one on behavioral finance. As a matter of fact, I believe we've decided, Jonathan, to break the behavioral finance into maybe 2 different white papers, because that's a huge topic in and of itself.
Right. One would be kind of what is it, and the other one would be how does that affect things?
Sure. I highly encourage everybody to read, particularly that behavioral finance white paper when it comes out, because I think we all find ourselves getting trapped into some biases that aren't necessarily all that beneficial in our investment strategies. So on the new year planning tips, I'm going to go through these relatively quickly. Of course, April 15th, nobody's going to forget, that's the tax filing deadline. Always good to get your information into your accountant as soon as possible. I say that maybe a little bit biased because I know, Chris, we like to get those tax organizers earlier than later.
Absolutely.
I skipped over the risk tolerance, but we talk about risk tolerance a lot. Foreign bank account reporting. Don't forget, if you have opened a foreign bank account and you have more than $10,000 in it, you're probably going to need to file a FBAR, which is an informational return. Even though it's informational, super important, because there are some big filing penalties if you don't do that in a timely fashion. And now, of course, it's a great time to start tax planning for 2020. And I know Chris and Jason and a couple other members of our team are already starting to put together some tax projections for clients and looking at withholding adjustments. Review 401k statements. Obviously, we're doing that for our clients, but if you're not a client of the firm, I would encourage you to do it for yourself. The contribution rate is now $19,500 in 2020, so it went up $500. If you turned 50 at any point in 2020, you can put in an extra $6,500, bringing the total of 401k contributions to $26,000. IRA contributions did not change. They're still $6,000 with a $1,000 catch up for those 50 and older. And consider a backdoor Roth. If you have no idea what we're talking about there, reach out to us. We're happy to talk to you about contributing to backdoor Roths. Great saving strategy, really, for many, maybe not everybody, but many folks out there. Review 2019 spending. Utilize the HSA, which is a high savings account, a health savings account for high deductible medical plans. I was getting those 2 all confused, but a health savings account. And then review your Social Security statements online. Confirm beneficiary designations and review estate documents. Rebalance your investment accounts and ensure you have proper insurance coverage. I mean, honestly, a lot of those things, that's what we're doing for our clients on a day-by-day basis. All right, get a copy of your credit reports, freeze your credit, and listen to Chris's update on the Secure Act, because honestly, not a lot of people, Chris, have even heard of the Secure Act. It just got passed, what, a couple weeks ago?
Yeah, it was part of the spending bill, and like a number of other provisions was, kind of included in that bill. So it was
Sure.
kind of unexpected and just slid in there.
And so, what is the Secure Act?
So the Secure Act stands for Setting Every Community Up for Retirement Enhancement. The majority of the bill becomes effective January 1st of 2020, although there were a few provisions, that basically look backwards.
Went retroactive?
Well. Exactly.
Yeah. Okay.
It was signed into law by the president on December 20th. And, the primary focus is it's intended to strengthen retirement security. So it increases access to tax advantage accounts. It acknowledges that careers are going longer, people are living longer. So and then in addition, they've kind of made it a little bit easier to put annuities into 401ks.
Sure. So the big components that I think impact the majority of our clients, and probably the majority of those out there, one is this RMD.
Yeah, and it's probably the most, immediate one, in the standpoint that effectively everyone needs to start taking distributions when they reach age 70.5 previously. They've just simply increased that age to 72. Like everything in tax law, there is a transition period. So just know that if you were one of the folks that turned 70.5 in 2019, so before 12/31/19, you're still going to follow the old rules. If you turn 70.5 after 2020,
after January 1st,
I'm sorry, of 2020, then you're going to go to the new 72.
Sure. So we talked about 70.5 forever, because I think that's been in there for forever. But now if you hear somebody say, hey, I take IRA or 401k distributions when I turn 70.5, you can correct them. It's probably 72 for those that haven't yet.
And it'll be easier to keep track of. 72 is an easier number to keep track of.
70.5 was odd anyway. Why half?
Yeah, exactly.
And then the other big one is the stretch IRA.
Yeah, and they had to find a way to pay for all of this stuff. So
and they did it here.
Kind of the deal that was thrown in there. So, in summary, what this does is it really says if you're a non-spouse beneficiary, once the owner of the account is deceased, they're going to have 10 years to take the money out of the account. Now, there are exceptions to that. They've actually included some language in the beneficiary definitions, and they've come up with this eligible designated beneficiaries. And so essentially what these, if your beneficiary is an eligible designated beneficiary, they're going to still be able to.
Like they're disabled, they're minor child, a couple others.
It's going to be your spouse, a minor child, you're disabled or chronically ill, or the beneficiary is within 10 years of age of the deceased. That's kind of something new, but they put that in there. The one thing I would say about that is if, even in those cases, when that eligible designated beneficiary is deceased, then the 10-year window starts on that. So that's kind of one thing. Like you said, we're going to be working with clients on this stuff going forward, but it is a significant change.
It is a significant change, and we will be looking through estate documents, looking at beneficiary designations over the next year or so in light of this significant change.
Yeah, the next thing we want to bring up, there really wasn't in the Secure Act, but it is impacted by the Secure Act. So the qualified charitable distributions really allow someone when they're 70.5 and previously had to start taking required minimum distributions, they could take those distributions and contribute them right to a charity and not be taxed on that income. So with the move to 72, we just really want to clarify that it didn't change this rule. So once you attain 70.5, you can continue to make those distributions to charities
and not recognize the income.
And not recognize him. The key being is you can't, in the year that you turn 70.5, you can't do this until you actually turn 70.
So if I turn 70.5 on June 1st, I can't make this charitable contribution on March 1st. I have to wait until I'm literally 70.5 to do this.
Correct. That's probably the most significant thing.
Yeah. And then the IRA contributions, this was something else that was a provision where before you couldn't continue to make IRA contributions once you turn 70.5, but now they're allowing you to. Is that
Correct.
okay?
And I think the one thing that, and a lot of stuff that I've looked at, just know you have to have earned income to be able to do that. So
Yes.
it's not like I'm 70.5 and I can do it. You'd
Good
still have to
point.
be working and have
Good
self-employment income or wages.
Good point. And then the kiddie tax. This was an interesting one. This one's kind of flipped back and forth over the last just couple of years.
Yeah, so I think what they tried to do was make this easier and simply just say, hey, rather than using the parents' tax returns, we can use the trust rates. Unfortunately, what they determined is there were a number of situations where the tax was unintentionally higher than what it was.
Right.
And so I think they said, well, the other way might have been more complicated, but it was probably more fair.
Sure.
So,
So
we're just
they've gone
reverting
back to it.
Correct.
Yeah. Okay. And then there's a few other provisions like these 529 allowable plan distributions being expanded.
Correct. You know, one of the things that we talk about a lot is the student loan debt, and so
Yep.
that's probably why this is in here. They basically allowed a $10,000 limit for 529 distributions
For loans.
For loans,
Yep.
correct.
Yeah, that's a good idea.
And it's effective. One thing to know with this one, where I said some of the things are retroactive, it is as of 12/31/2018. Not that you would have known to do it, but by chance, if you did take a distribution and pay down a loan in 2019, you would fall under this provision.
Perfect.
So,
and then the childbirth or adoption distributional allowance. Here.
Yep, and this is going to have limited access or limited application, but it is there for anybody doing that.
Yep. And then there were several provisions that were more employer oriented. We won't go through them in detail, but high level, while we have small businesses can do these multi-employer plans.
Yeah, this is where we get into access. It's making it easier for employers to get into plans.
Sure. And safe harbors and, you know,
correct.
I don't think this is probably going to be applicable to many folks on today's webinar, but you certainly can look through this. And if you have questions on any of these provisions, feel free to reach out to your SilverOak advisor to discuss those provisions. And here's a few more that mostly impact, again, employers.
Correct.
So with that, where are we regarding the Secure Act? We talked about the big issue is estate planning and how it's impacting stretch IRAs particularly. So we're going to be reviewing stretch IRA kind of consequences and the loss thereof with our clients.
Yep.
And going through their estate documents, going through their beneficiary designations, talking to them about is it better now to name maybe a grandchild or a child or really a charity maybe as a beneficiary versus one of these younger generations. And the other thing with the Secure Act that you put here, John or Chris, is the window for Roth conversions may be a little bit more clear, and more people may want to take the opportunity to do a Roth conversion as a result of the Secure Act.
Well, as I said before, I mean, this provision is a revenue raiser. And so as a result, we all need to basically just be a little more thoughtful about the taxes that are going to be due based on our estate plan. And basically from a tax planning standpoint is, you know, what are you going to use those dollars for? Let's try and make it as efficient as possible.
Great. Well, good. That's a nice summary of the Secure Act. If anyone has questions with regarding the Secure Act, again, reach out to your SilverOak advisor. You can also call Chris directly. Chris, your number is what, 952-896-5707?
That's correct.
And if you're not working with a SilverOak advisor and you want to get a hold of somebody, again, Chris could be a resource for you, or you can call me directly at 952-896-5701. We want to thank everybody for the time that you took to listen to today's webinar and hope you have a fabulous day. Thank you.